It's now time to learn more about Larry's tools and how to pick up on the signs that the big boys are in the market. In this very important segment, Larry will help you understand how to follow the smart money. Take it away, Larry.
Welcome back. This is the third video, and in this series I'm going to be talking a little bit more about things that cause the market to move and then show you what market structure is. In the last video we were talking about the commercials, how incredibly important the commercials are, that we can monitor the commercials by looking at open interest, also by their actual buying and selling on the Commitment to Trader report. But there's a third way we can use the commercials as well, and that's to look at the premium. Remember in the first video, the first hour's presentation, we talked about premiums, that the only people that bid a market to a premium are commercials. We can actually look at that premium relationship, and we're going to show some examples of that now, so you can take a look at the relationship of the premium, and we'll just chart the premium if the nearby is more than the distant contract. And when that happens, you'll see the markets tend to get very bullish. Remember, the important thing is that traditionally there's no premium in the marketplace. That's standard. That's a carrying charge market. You can have a bull market in that condition or a bear market in that condition. But when we go to a premium, we have an outstanding opportunity because that's a commercially driven bull market. So let's take a look at an example of a commercially driven bull market. This happens to be sugar. Sugar went into a premium December of 2002. Notice that at this point, the premium, or in this case the red line, shows that the nearby contract was selling for more than the distant contract. And that's extremely unusual. That is not the way the markets usually move. As it goes into a premium, that's telling us the commercials want this market and they want it badly. And that's why we had the huge up move of about a 3-4 month time period in the sugar market in the latter part of 2002. Then as the premium starts to dissipate and wind out of the market makes its high. Notice where the premium made its high is prior to price making its high. So as price has that last up thrust to the high price, the premium isn't there. The premium is lessening. The commercials don't want that nearby contract as badly as they did before, and that's the top in the sugar market. It's not unusual to see this in many markets as it takes place. We'll take a look at a couple of others. Let's look, Mark, if you would, at I think cocoa. We had a good premium in this year. And you'll see what happens when the premium comes on into the market and as the premium starts to fall out of the marketplace. You can see this on your chart books. In the old days when we had paper charts, most of the services plotted it. But very few people have talked about the importance of this. Even myself, I tend to forget it. I overlook it. We all should spend more time looking for a premium in a market. It's pretty easy to see that if it's there by just looking in the newspaper every day and seeing if the nearby contract is selling more than the distant contract. If so, fire up your computers and you can take a look. When we go into a premium cocoa, go back further than that, Mark. Went and go way back in time. We may not have the contract. Mark, let's see if we can find another premium. Typically, as we go into a premium situation, the market will rally. In this case, it didn't. But most of the time, we'll see that take place as we go into the premium in the nearby contract. And Mark will pull up another example. We can see some in it. It would be very unusual for this to happen, remember, in an abstract market. We want to use this technique in the natural resource markets. And if a market's at a discount, we'll look at some of those. Explains why a market such as wheat can't get going, because there's no commercial bull market in it. I think beans may have gone to one as well, Mark. We'll let you look around a little bit in there. But it's really an easy process to begin. Get your daily newspaper, look at and see where a premium is, and notice those premiums as they build up. Now the big difference is in a commercial bull market, the market will have a great big run and it doesn't have much of a pullback. In a speculative bull market, the market will have a run up, a run down, a run up, a run down, like we've had speculative bull markets in gold. And it'll have big run ups and big collapses against it. Big runs up, big collapses against it. That's the difference between a commercial bull market and a speculative bull market. You know, in the example we saw of sugar, it just kind of went up and up and up. It never gave you a chance to buy, to get back into it. And everybody's waiting on the sidelines. They don't get an opportunity to do it. So remember, are you in a commercial bull market, or are you in a commercial bull market or a public bull market? And the public bull market just has big rallies and big breaks. A commercial bull market tends to be very tight and a really strongly driven marketplace. So that's how I look at the commercials. I look at the premiums, their buying activity, and the open interest play. Really, all this comes down to a very, very simple equation to me, because I'm not smart enough to analyze all the news, listen to everything that's out there, and form an opinion. It'd be forever trying to figure it out. So it's easier for me to just say, what are the commercials doing? And I'm going to follow that. That truncates a whole lot of work. And over the years of trading, some 40 years now, I haven't found anything better. And I don't have to pay too much attention to what goes on in the news. I don't even read the newspapers, frankly, other than to get the sports scores and a little bit of humor out of the papers to see what the politicians are doing in Washington, D.C. Other than that, I've never found the newspaper that told me to buy when I should buy. I've never found the newspaper that said I should sell stocks in 1999 and get out of them. They weren't saying that. They were saying buy stocks. So I don't pay attention to news because the commercials are really saying it all. That's the news that I want to listen to. These guys are so good. Plus news, gosh, one day it says it's bullish, and the next day it says it's bearish. And newspapers have always explained after the fact what happened. They don't explain in advance that this market is going to do something. Plus, one thing I've noticed is that, has any of you ever had a newspaper story written about you? Anybody ever been in the newspaper, a story written about you? Could you just raise your hand, those who've had a story about them in the newspaper? And how many of those stories were exactly correct about you? Right. Me too. They never said I was such a nice guy that I am, whatever. But I asked this question, all the hands come down. Yeah. So if they didn't get a story right about you, are they going to get it exactly right about something as arcane as soybean meal? Not only that, do you think that possibly some interest out there would like you to buy when they want to sell? That would never happen, would it? Somebody would never snooker us with news, would they? So I don't even pay attention to the news at all. If I see a market go into a premium, as bean oil did in 2002, it goes to a premium over here, buy the thing. We're going to see the market rally, and away it goes. Premiums are really important. When premiums come on, I want to look to be bullish in the marketplace and take buy signals. It's a very strong indication of what the commercials are doing in the marketplace. Well, there's another indicator I like to pay attention to. It's an interesting index. I wrote the first book ever written to my knowledge in the history of the world about it. It's about the seasonal tendency of markets. Markets have a seasonal pattern that is somewhat repetitive. It's not the same every year, but it's a good idea of when wheat and corn and cattle and the S&Ps and treasury bonds will rally. So we'll take a look at some of these to see what the typical seasonal tendency is. Mark has soybean oil for us. Now we're looking at a weekly chart here. So from the dashed lines is a full year, from here to here is 1 year, and the next year from dashed lines to dashed line. What usually has happened in soybean oil is around January, the market started to rally, as it did this year. Most January, soybean oil puts in a low and tends to top out around August of each year. That's when the typical seasonal high has usually occurred in the marketplace. It won't be the same every year, but alerts us to opportunities of when they should exist in the marketplace. Wheat has a very strong seasonal tendency. We can date back into the 1600s. Long time. Usually bottoms in July, runs up and has a sell point in it. A high typically happens in the November to December time period. This can be of a lot of value to you producers because you got to market your wheat. Well, you don't want to sell it in July. The most seasonally advantageous time is to sell it after harvest, sometime in that November or December time period. That's when most of the highs have taken place in the wheat market. So it can help you in your hedging process. Say, oh yeah, let's wait till the time is right to put on our hedges or to sell our crop, depending, of course, on your price structure and what it costs you to produce the wheat. But it'll give you a sense of when this is going to take place in the market. All commodities have some form of seasonal tendencies. Some are more reliable than others. A very reliable one is treasury bonds. And I think there's a good reason why. I think the treasury bond market is influenced a great deal by the Federal Reserve System. There's a time when the Federal Reserve System wanted to lower interest rates, primarily before Christmas, for Christmas sales, and for ranching and inventory and buying equipment and fertilizer later in the year. The low tends to come In the first part of the year, around May, right after people pay taxes in April, has been the seasonal low, and the seasonal high tends to be around the first of the year. Then you get down into that April time period, and look what happened in 2003. That's when the huge, gargantuan, big flash move took place in the bond market, around the end of April, first part of May. That's the most reliable one. The next one is that year-end rally in bonds that starts in the October time period, right around October, second week of October. Usually the markets rally as the Fed lowers interest rates to stimulate Christmas sales and to allow farmers to go buy equipment and get fertilizer and get ready for next year's crop. So there's reasons why these things take place, and certainly Treasury bonds have a very strong, powerful seasonal influence. Any market you'd like to look at, we can pull up the seasonal chart and look at it. If there's any market that you people have particular interest in, raise your hand, we'll do it. We'll take a look at some of them. And while you're thinking, somebody come up with one for me, please. I'll show you the strongest of them. Pardon? Natural gas. Great. Let's look at natural gas. The seasonal tendency of natural gas has been for a low to come in the middle of the year, around July, and take off. Ooh, we're getting right close to the seasonal low, and natural gas now is coming up, isn't it? Usually there's been some type of a low in there. In this case, a huge blast off. And the highs have come in the latter part of the year. And the markets have come down most of the time in the latter part of the year, or in the first part of the year, first couple, 3 months of the year. Perhaps the most reliable of them that we trade a lot would be the S&P 500. It's just a wonderful seasonal tendency. And Mark, if you'd pull that up for us, we'll take a look at it. The seasonal tendency in the S&P has been for a buy point in the October time period with a rally into about July. Now, last year that didn't happen. The year before, you can see what happened when we got in July. Big decline hit the market. We're almost there this year. Same thing happened in 2000. We had a rally up till the seasonal high should come in, and down went the price of the S&P 500. Seasonal tendencies are a real good indicator of, generally speaking, when we should see a market have a significant low and a significant high. But I don't take action just because of a seasonal pattern. They're not strong enough on their own. What I like to find is a market where the commercials are buyers, the advisors are sellers, and there's a seasonal low there to be a buy. I want that to confirm my trade. It's confirmation. It's not origination of a trade. Some people take trades just based on seasonal structure. I don't think that's wise. And I'm the guy who wrote the first book about it. But what I've learned since 1973, when that book was written, that they're good, there's a real place for them, but it's the last little tumbler we want to click together in our lock. It's certainly not the first one. But I like to see the seasonal stuff come in to confirm that I've got a good trade on in the marketplace. But I very rarely do something just because of the seasonal tendency, because markets change, crops change. Good one is soybeans. The soybean seasonal patterns change quite a bit because Brazil started to produce a lot of soybeans. Well, guess what? They have a different harvest time in Brazil, south of the equator, than we do north of the equator. So I always have to be thinking, what's going on here? But they are, they're a good tool, but they're confirmation. They're not the origination of a trade. That's the way I use the seasonal influences. And I do look at them. They also have them available for stocks. Somebody give me a stock, any stock that you follow. Anybody follow a stock? Make one up if you don't.
Cisco.
Cisco? Okay. The one I followed, there's Cisco. The high usually comes in about January of the year, it looks like. Again, great selling point there. A little early here, but down comes the price of the stock. IBM has been a particularly good one. There's a stock a lot of people follow. IBM usually bottoms the 40th week, I think, of the year and starts a rally. And then around the first of the year, it starts to come down. I first noticed this in 1974, and that's a pattern IBM has continued trading at year after year after year. Most major stocks bottom in the October time period. With an exception. Here's an interesting exception, Walmart. I would have thought that it would bottom in October as well, Christmas sales and all that stuff, right? But notice it usually bottoms in January of each year, as it did this year. January tends to be the strongest buy point, not every year, but most of the years in Walmart. The best seasonal tendency we ever had, we used to trade eggs. When do you think eggs rallied? just before Easter, right? Yeah, they don't trade anymore. That was like a lead cinch deal. Buy eggs about 2 months out before Easter. Everybody bought eggs, and the price of eggs went up. But we don't get to trade eggs anymore. That was the all-time seasonal. But you think about it, there's some reasons why some commodities rally at certain times of the year because of consumer demand and production and harvest and things like that. So I do like to pay attention to seasonals, and it's a good tool. There are some other tools that I use I'd like to show you now as well. One that I like to use would be accumulation and distribution. I have done a lot of work trying to detect what major buyers and sellers are doing in the marketplace, and I'll show you how I go about doing that. We'll start now to look at daily chart action for the very first time. Typically, if you call your broker, they'll say, well, the market closed yesterday at $60 a share or 60 cents a share if it's a commodity, and the day it closed at 58 cents a share, $50 to $8 a share. It's down for the day because today's close is lower than yesterday's close. Looks logical. However, there's another relationship going on in there I'd like to show you, and really watch this carefully because you're going to see something that to me is the most important figure in the marketplace. And that's where the market opened today. If the market opened down here today at, say, 55, notice what happened. The market closed at 60. Because of some news, the market gapped way down, fell down to 55. That's where it opened. Then the market started to come back from 55 to 58, and it actually rallied off of the opening 3 points. Well, who moved the market from the opening to the close? I think the professionals. The professionals come in as the market opens, they see the opening price and there's a battle and they drive it higher or they drive it lower. That's professional activity. Guys like myself, floor traders, large off-floor traders, we key off the opening price. The public just says, where to close today? What's the closing price? You look at the closes, I look at the openings to the close. Here's the big difference. If we looked at this close to opening, we'd say the market's down 2 points for the day, minus 2 points. But if I look at the opening to the close, I actually have 3 points of buying or closing 3 points above the opening. So you say, aha, professionals came into the market and bought today. So I can actually take that value and make an index out of it to help me measure accumulation and distribution in the market. All that I do is take today's close minus today's opening. So if today's close is 58 and the opening is 50, I add 8 points of buying. By the same token, if today's close was 58, but today's opening was 56, I've got minus 2 points. I'm sorry, let's make this 58 and 60. I have minus 2 points because we opened at 60 and we sold off the opening at 60. So I'm simply taking the opening to the close. If I closed above the opening, it's a positive number. If I closed below the opening, it's a negative number. That's all that it is. Then I'm going to continue to keep this number running. I'm going to take the average of the last 14 days. So I'm going to use a 14-day average. Of that value, of what we'll call professional buying. That's professional buying. Which is today's close minus today's opening. I'm going to run that line for the last 14 days, and I'm going to then look for price to diverge from what the professionals are doing. It should look like this. Typically, you'll see a market start to run up like this, but the professionals will be buyer, and then they start to diverge. So as price makes a higher high here, the professionals are actually getting out of the marketplace, and they're not going with the market. Take a look at wheat in March of this year as an example. A buy signal would be just the opposite. In a buying example, we're going to see the market coming down like so, and accumulation will start to come up. So in face of this weakness, the professionals are actually buying weakness. They're buying in here, and we see that because the index is coming up as they're accumulating in face of a weakness in price action. That's the divergence that we're looking for. And now we'll take a look at a couple of examples. Notice what happened in wheat in March of 03. Look how the market makes a new low in here, new closing low. But if we look at the professional activity, look at the divergence. New low in price, but not in accumulation. The professionals were accumulating this heavily in here. Can you see the divergence that goes on there? Currently, as we look at it, well, not much has happened. There's no divergence. We had a lower high in price, a lower low in accumulation distribution, so we didn't have anything screaming at us one way or another. Price is above this low, these two lows. Accumulation is above those lows, so there's been no divergence going on in that market. Let's look at corn, Mark, if you would, in July of 2002, and you'll see some divergence in that market as well. The market just really starts to blast off to the upside as we're making new lows in here. Look what happened in accumulation. The professionals have come in and started to accumulate it. As we come into the top of that year, we'll come forward a little bit in time, and you'll see that the professionals now have gotten out of the market. Look at this big rally. Price is so deceptive. If you look at just the top part of that chart, you say, gee, that was a big rally in corn, but look at the accumulation. The professionals are not there at all. They left the marketplace. As we make a new high in price, we don't make a new high in accumulation, telling us, we want to be a seller in that price area because the professionals have gotten out of this market. They're no longer interested. Down in the prior point, they were accumulating, weren't they? Market's coming down, the market's weak, they're buying. Market runs up, they get out. So it's a great way to look at the divergence between price activity and the measure of accumulation. We'll look at silver in October of 2002. And we'll even look at silver up into the current example, current time. Look what happens in silver. A new low in the market. But look what happens in our accumulation line. The professionals didn't continue selling. We should see accumulation break to a new low. It holds above the prior low. The market takes off to the upside pretty much with a vengeance. And as we make higher highs, we continue to make higher highs in the accumulation line. Until, look what happens up here. Big distribution going on in the market, or maybe who knows, but look what the accumulation line falls out of bed. We have a high close up here, and look where accumulation is. They got out of the market. No wonder silver had a decline. Until when? Until we have a lower low in price activity of silver, but we have a higher accumulation level by the professionals. In other words, the professionals were accumulating this weakness in the silver market, and then silver took off to the upside. So it's a great tool to focus us in now on an intermediate term area where we're looking for divergence between price and the accumulation going on by the professionals, the people who move the market from the close to the opening. It's simply a 14-day moving average of the difference of that value. Could be that maybe there's a better value to use. I've just used a 14-day average all these years. You might want to try a 20 or whatever, but 14's worked pretty well for me, and that's what I've used all these years, and you can see it continues to work quite well. Same thing works on stocks. It can even work on intraday charts, but I prefer it on daily charts on whatever market I'm following. I like to know what it's going to do. Let's take a look at soybean meal, Mark, and see what's been going on in soybean meal here recently. Soybean meal had a high in price up here, and we continue going to a little higher price level, but the professionals were pulling out of the marketplace. To explain what's going on up here. Professionals buy here. We have a nice divergence. Soybean meal is lower in price, but higher in the accumulation line. We make a new low here, but we don't in accumulation, and away goes the market to the upside. Now, as we tried to rally back into this old high zone, in this high compared to the other highs, we're way below it in accumulation, saying probably have a little weakness ahead of us in this marketplace. Well, if you're going to keep daily indicators, and you can do that on your computer or in your charts, I certainly would say that's one indicator you want to follow is major accumulation distribution. Question?
S&P?
Let's look at the S&P 500. You'll see something interesting there as well. Notice what happens in the low of March 2003. We have the lowest low the market has been for a couple of 3 months, but look at the accumulation in the market. Look at what happened. The commercials bought the heck, or the professionals bought the heck out of this decline, didn't they? Big divergence, and no wonder the market takes off to the upside. Now we've got a little trouble. The market makes a new high, and the professionals have barely made a new high. They're starting to get out of the market. It's not as divergent as this was. Notice what happened back here. Mark will click on the high in accumulation. The high in price came a couple days later. Go back a little bit more in time, Mark, and you'll see other examples of that where the market has a big rally in here from this point to this point, but not an accumulation, and down comes the marketplace. So another example is October 2002. We made a new low in price, but accumulation didn't. We held up an accumulation, and we had a couple-month rally out of that area. I pay a lot of attention to accumulation in the marketplace by simply measuring what the professionals are doing. I started doing this in 1966. That's how long I've been using this. This is the first indicator I developed, looking at the open to close relationship. And it's so fascinating for me to see, here it is. We didn't even have these indicators, or didn't have these markets to trade back then, treasury bonds and S&Ps and Swiss franc and all that stuff, and stuff still works. It's a real strong indicator to kind of give us an X-ray view of what's going on in the marketplace. That's what I use it for. Any other markets anybody like to see it on? Anybody have a position or a stock? Or the NASDAQ? Take a look at NASDAQ. I don't know why you'd want to go slumming and trade the NASDAQ, but yeah, gosh, look at the NASDAQ on this last ditch rally. The accumulation came out of it, didn't it? We couldn't make a new high in accumulation as we made a new high in price action. At the lows in the NASDAQ, we made new lows down here, but we didn't in accumulation. Market gets back into this low zone. Look at all the buy that came up. This low is way above this low, whereas price is right back at that same low. What's really fascinating for me is when I take this tool in the other countries, because I have traded real time in all these other countries, China, Singapore, Australia, Russia, France, same thing works. Take the exact same indicator. We have to change it in China, because in China, the exalted color is red, so if a stock is going up, they paint it in red. And if it's going down, they paint it in green, which is real hard for us to acclimate to because we're so used to red being bad, and to them, red is a great color. When you get married in China, you get married with a red dress on. That's a big. So we had to switch all the colors of our indicators. But the essence is still the same. That closed to open relationship is a real measure of professional activity in the marketplace. And it's a simple indicator to maintain. It doesn't take very much work, even if you do it by hand. Well, let me talk a little bit about some of the cycles that take place in the market now. There's some short-term cycles I'd like to explain to you, how the market actually moves on a shorter-term basis. And I'll show you how I have come to understand that. First of all, we can measure the short-term, intermediate-term, and long-term trend of the market in a very simple way without math. If we have 3 market days, notice this day's low has higher lows on both sides of it. So we can say that's a short-term market low because it has higher lows on both sides of it. And as the market comes up, we now have a day that has lower highs on both sides of it, so that is a short-term market high. Now, in the old days, before computers, I kept all these in notebooks and would simply circle or ring the high of that day. Would keep a column open, high, low, close, and we would circle this bar's high as a ringed high, so I may refer to it as ringed highs. As the market comes down, we now have a short-term ringed low here because, again, we have a day that has higher lows on both sides of it. That means we've got a short-term low there. Market starts to come up again, and we have a short-term high. Starts to come down. This is a short-term low, isn't it? because we have higher lows on both sides of it. Now we also have a short-term high over here because we have lower highs on both sides of that high. Now something really interesting has taken place. Remember I said if we have a day that has here's our day, and we have lower highs on both sides of it, that's a short-term low, a short-term high, with lower highs on both sides of it. If we have a short-term high that has lower highs on both sides of it, that is an intermediate term high. We know that because it has lower highs on both sides of it. So this is an intermediate term high. I'm going to abbreviate intermediate term high. So a short-term high can become an intermediate term high if it has lower highs on both sides of it. Now continuing along, see the market starts to come down like so. Now we have a short-term low, short-term high, short-term low. Oh, look what we have. We have a short-term low with higher lows on both sides of it. That means that is an intermediate term high, intermediate term low, because we have higher lows on both sides of it. Now we continue as the markets move, always moving. Markets are always moving. We have another intermediate term high over here because we have lower short-term highs on both sides of it. And someplace back here we have a lower intermediate term low, which means this is also a long-term high because that intermediate term high has lower intermediate term highs on both sides of it. So now we've been able to identify all short-term, intermediate term, and long-term moves in the marketplace. The computer will allow us to do a lot of that real quickly to get all of the short-term swing points in a marketplace. The Genesis data is the only one I know that does this. Notice that the green lines will pick up all of the short-term highs and lows, and then we can go, well, there's an intermediate term high because I have lower highs on both sides of it. So it will tell us where the intermediate term swing points are in the marketplace. It can be used in a lot of different ways. The main way I use it is to know when to get in and where to take some profits, and I'll start to explain that. But it will tell me, oh, there's an intermediate term low because I have higher lows on both sides of it. Intermediate term high over here. So my intermediate term in the market is there to there and here to here. Now I've got lower highs on both sides, another intermediate term swing. Intermediate term swings tend to be repetitive in the length and the time. But I like it just to see my market structure because, go back to my chart over here, if I see I have an intermediate term high that's lower than the prior intermediate term high, the intermediate term trend is down. And I know that when I take out this bar's low. So I can be a seller there saying, I've taken out this bar's low, which tells me this is an intermediate term high, which is lower than that intermediate term high. So my major trend has been to like this. This down move is bigger than the up move, so I should expect an intermediate term down move of at least the same magnitude. So that's what I like about market structure. This was a whole idea originated with a fellow by the name of Henry Wheeler Chase. He's the one who came up with the idea of these short-term ringing effects. One of my additions to it is this. Mr. Chase, and this is really important, so you want to really watch this one carefully. In Chase's work, he would say there's a short-term ringed high because I have lower highs on both sides. And this high has lower highs on both sides, so that's also a short-term high. It isn't. Let me show you why. This day is what we call an inside day. By that I mean this day's range was totally within the prior day's range. So the market didn't go higher, and it didn't go lower. It just kind of hung out there. So we don't know that that's a short-term high until this happens. Then we can say, okay, that's a short-term high. But what could happen is we have this exact same configuration, and the market goes like this the next day. So we have a short-term low here, but we still don't pick up a short-term high because the market's continued its trend direction move. So if there's an inside day, remember an inside day is a bar that's lower high and a higher low, or it could be equal to the prior day. If that's the situation, then we don't know until the following day or until we break out of that prior day. And then we can say, oh, there's our short-term swing points in the marketplace. So watch out for inside bars. Inside bars are really deceptive. You've had a lot of inside bars around bad trades. Question?
What if that, where you got your inside day, what if that was a double top like that? And then the next day was?
This, which day now? This one?
On your first,
this one, okay.
There, put him up to a double top.
Mm-hmm.
The inside day one.
Oh, the inside day? If it's equal to, it's still an inside day. It can be equal to or less than. As long as we're talking about that, let me show you something. This is kind of interesting. I like to see a show of hands on this. You people like to raise your hands on this one, okay? If we have a day that comes up like this, and we've been coming down like this, come up, and the next day we do this. So we've had days with equal lows. The market met resistance here once, came back to it, met support there again, met it here again. What do you think is going to happen? How many think the market will go up? Raise your hands. How many think the market will go down? How many don't have a clue? How many don't have arms? Okay. What I have experienced, and this is something I learned from a good friend of mine, Tom DeMark, is the vast majority of the time you will take out this bar's low. If you have two equal lows, you're going to take them out. Most of the chart books, remember I said don't trust anything in this business? Most of the chart books will tell you that this is support and the market will rally. But my experience is you'll take it out by at least a tick or two. Now you may turn right around and go back up, or you may just fall out of bed, but you will most of the time take out those lows. Equal highs are taken out, equal lows are taken out. And most of the chart book guys tell you that that's not so. I'll digress for just a moment on that point, too. I'll tell you, this commodity business it's worse than heavyweight boxers, I think. It's just like everybody's Don King that seems to be promoting commodities one way or another, and I just have to tell you, be really careful of what's out there. And everything you hear, verify it. Don't trust it. Just really make certain. If somebody says, I did such and such, they ought to be able to prove it with real-time brokerage statements. They ought to have won trading championships or have something to show of their success. Because there's a lot of bamboozlers in this business. And I don't know that it's all intentional. I think some people just get carried away with themselves or what's going on. If they get on a hot streak, and everybody can get on a hot streak occasionally. Just be real careful. I've seen so many good people hurt by bad people in this business. That's the only downside to the business that I've seen. It's just there's always somebody out there with some type of hustle, and just be careful of it. That's all I can tell you. And when people tell you something, especially about an indicator, oh, this means such and such, check it out. Look at it. Fire up your computer. Look at all this stuff and see if it really means that or not. I found so many things that people talk about that really aren't that way. In fact, I'll show you a few of them now. A couple of my favorite patterns. One of my very favorite patterns I call fake out, because the books seem to all have this wrong. The books say that this is a reversal day, or a key reversal day, some people call it. Notice what happened. The market made a higher high and a higher low, but it sold off and closed down for the day. And the technical books say, oh, that's how markets top. That's market highs are put in that way. That's what they say. We'll look at some examples, Mark, if you would, where the computer will just flash up all these days where they say the market should top, and you'll see that's not how markets top. There's a way how markets top and how markets bottom. This is what I call a fake-out pattern. I actually like to be a buyer at this bar's high the next day. Because the public thinks, oh my gosh, the market had this big day like this, closed way down like this. They say it's a sell signal. Occasionally it is. But if the next day it can get around and get back above that bar's high, I want to be a buyer there. of course, that's conditional on the commercials and the seasonal and the advisory sentiment, all that type of stuff. But if there's a condition there, then I want to use that as an entry point into the market because it's faked everybody out. They're looking at it and saying, oh, gosh, that looks so bad, and might be. But when the market does the unexpected, that's the message to me. It shouldn't immediately reverse the next day. If it does, then I want to go with it. Mark, do you have some examples we can look at there? We'll take a look at some of the fake out bars. Now, Mark has painted the fake out bars in green. This is how they say the market should top. The books say that higher high, higher low, and a lower close should be a top in the market. I want to be a buyer at this next bar's high. I want to be a buyer there. I want to be a buyer. There's another fake out bar there. Well, we don't top that day. We talk a day later, and I probably get out over here. Let's see another fake out bar we've had, Mark. This is what they say is a fake out buy right here. The red one is a fake out buy. Lower high, lower low, higher close. I want to be a seller at the next bar's close, just to reverse, and the market continues coming down. Notice in this chart of the S&Ps, none of these days have fake out bars at the highs. The way markets bottom, historically, most markets, most of the time, trade in a very precise fashion. I'm going to make this an over-exaggerated view, but markets do this. It's the true cycle of the market. Stocks, commodities, doesn't matter. If we look at just the daily high-low close, daily high and daily low, that's what it looks like. It's the close that tells us what's going on. And notice what's happening in this close relationship is the further up we get in a rally, the higher the close is within the day's range. Markets top out closing on their highs. Markets bottom most often closing on their lows. And this is such an important pattern for you to understand because, trust me on this, when the market's closing on the high and you're long and you're making money, you will not believe that it's bearish. You'll hold on because, oh, it's finally closing on the high. That looks so bullish. And you have to say, that's not how markets work. When it looks real good, it's really bad in this business. When it looks really bad, it's really good in this business. I mean, this business, I love feast, famine, disasters, pestilence, war. That's what we need for explosive moves in the marketplace. What looks bad is really good. It looks so bad to buy stocks in March of this year, 2003. It looked like nobody would buy them. Or last October, nobody would buy them. That's when you want to step in and be a buyer. Well, we can actually let the market tell us that when we start to close on the lows. Notice this close, as we start to decline, the close is pretty far up in the range. It starts to drift down, 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 and then it closes right on the low of the range. A couple of those you're probably going to bounce in the marketplace. Then that cycle starts all over again. Now, most people talk about cycle in terms of days, X days from here to here. Well, that's not the cycle. Time cycles are not all that critical. The critical thing to me is where the close is within the relationship of the range. And somebody just call it any market. I want you to choose the market. We'll look at an example of that. Somebody just give me any market.
Soybeans.
Soybeans. Great. We'll take a look at soybeans and see how soybeans have topped and how soybeans have bottomed. Okay, here's soybeans. Notice how we topped right here. We closed just about on the high. Pretty close to the low. We're off the lows there. Closing right on the highs. Down come soybeans. Close right on the low. Up goes soybeans. Close right on the high. Tops put in. We close right on the low. That's current. Let's go back to when soybeans bottomed a while ago there, Mark, and see how soybeans bottomed. Closing right on their low. Closing right on their high. That's how markets move. So we have to see, when we see these closes right on their lows, we'll say, we're probably getting close to some type of low in the marketplace. Yes?
On January 3rd, about the 3rd there, you get that big day.
This,
you get a top close that almost says the same.
Just about on the high of the day. Say, yep.
And the day is big.
I'm sorry? And it's a large range day, right. So remember, these ranges show us emotions in the market. Large range days are caused by a lot of emotions. So everybody's emotional and everybody's bullish, and everybody can't make money doing what we do. So you have to say, hey, this is when you pitch them out. This is when you sell them. This is not when you buy them. The other part, and it's a good thing you mentioned that, the other cycle in the market, we go from small ranges to large ranges. Now, that's really an important cycle. Because as you'll see, we have these large ranges up here, then we have little ranges, and look at this market gap from here to here. Large ranges, cut some little ranges, large ranges, little ranges, large ranges. Natural cycle. What happens to the public? They see those large ranges, they say, man, that's for me. Look at all the money I could have made. So they get in the market following large ranges, and they go these little ranges, and nothing happens. Just nothing goes on at all. And, I guess the line now would be, hey, I lost another one to Ditech. You know that guy in that commercial? Right? Well, that's it. I lost another one to Ditech. Nothing happens. And they get bored. They get all these, I get out. Then they get large ranges again. They go, I'll get involved. Then the whole process starts over. Small ranges to large ranges. So I like small ranges because I know a large range is coming. The other ways I mentioned earlier, we can look at a blast off in there, but this is one way of getting into that. Small ranges are really exciting ranges. Large ranges, let's look at the S&Ps for a moment, Mark. When we start to look at large ranges in the S&Ps, like large ranges in there, it's about over. Little ranges, there's the blast off to the upside. Little ranges, large ranges, little ranges. Little ranges up there, boom, large range yesterday. So I, especially as a short-term trader, want to focus on short-term days because then I know I've got a long-term range coming, a larger range, an expansion of range is going to happen in the marketplace. Really important cycle for us to look at. So we've looked at cycles in, if you will, of close within the range and small ranges to large ranges. Those are the two most dominant cycles going on in the marketplace. Another one I guess I'll talk about very briefly as well as for the stock market. I'd like to predict for you when the next bull market will start in stocks. And this has great application to us because a lot of us are trading the S&P 500. You could do that as an investment or as well as a trade. And there's definitely a time when this market has peaks and has troughs in the marketplace. And I'll show you a study that I did. We'll go the S&P cash, Mark, if you would. I started following the market in 1962. By 1966, I was trading the market, thinking I really knew a little bit of something. We had a 1970, 69, 70 bear market, and the market came down, and I made a killing in that bear market. However, the market did something like this, came up like that, and then took off again in a bull market. Well, I had been short from someplace up here, and I should have covered my shorts here. I didn't. I wasn't smart enough. I left a lot of money on the table, took some lickings, and covered my shorts here, and the market ran away. That was good, but I left all that money on the table. The worst pain in life is leaving money on the table or having your brother-in-law make money when you're not. I mean, there's nothing hurts more than either of those two events. So that was the jam I was in. So I'm looking, what did I do wrong here? This was 1970. And I look back when I started trading, 1966 happened to be a low in the marketplace. And I look back to 1962, which is a low in the marketplace. So, look at that. 62 to 66 is 4 years. 66 to 70 is 4 years. So I wonder if something's going on. Is something going on every 4 years here? So I went back to 1958. And Mark, if you could go back now to the 60s, let me take you back in time. And notice what happened. This was 66, and this was in 1970. That's an observation I made and wrote about in my newsletter in 1970. Said, hey, 4 years. So 4 years prior to 1962 would be 1958. If we go back to 1958, look what happens in 1958. Big bull market. If we subtract 4 from 58, now I know some of you have trouble with math, so I'll help you. That's 1954. If we go back to 1954, 54 is an entire big bull market. If we subtract 4 from 54, we go back to 1950. 1950 starts a couple-year bull market. If we subtract 4 from 1950, we go back to 1946. October, that's usually when bull markets begin, another low in the market. If we subtract 4 from 1946, we're going to get 1942. Year I was born, about October, and away goes another bull market. If we subtract 4 from 1942, we go to 1938, about October, another bull market begins, actually, in this case, a little earlier in the year. Subtract 4 from 1938, we get 1934, and look what happens about October 1934, another bull market. Here's the one problem. If you subtract 4 from 34, we get 1930. That wasn't a good time to buy. But if you subtract 4 from 1930, you get 1926, which was the start of all the huge up move that took place into the crash of 1929. The wrong math? Oh, you don't have more data on it. Yeah, but if you look at 1926, you'll see that a huge bull market started in 1926. So I made this observation pretty cool. Every 4 years, it looks like stocks are bottoming. It also tells a lot about the economy and ag prices as well. So how did it play out in the future? Because I didn't know the future when I made this observation in 1970. So now let's go back to 1970 and we'll come forward in time and see what unveiled. The reality now of the 1970 observations, we should have a low in 1974. Usually they come in about October, and look where we were. Start of a bull market. If you add 4 to 1974, you get 1978, about October. Again, the market flops around for a while, but continues on to the upside. If you add 4 to 1978, you get 1982, which is the start of the largest bull market in the history of mankind. Now, what's really noteworthy about that, I wrote a book in the first part of 1982. I was living here in Montana, and I saw a book in Kalispell, Montana, at the checkout stand buying groceries, written in 1981, Howard Ruff's book, How to Prosper in the Coming Bad Years. And that dirty dog, we got good times coming. We had a 2-year coming up. So I wrote a book that came out that year, How to Prosper in the Coming Good Years, predicting a major stock market low in 1982. That was on record prior to the market low. That was January of 82. I was on a book tour promoting the book. And I literally told people on every talk show I was on, buy stocks, mortgage your house, buy stocks, get a second mortgage, buy more stocks, and then get a third mortgage and buy more stocks. We're going to go up. Well, look what happened. Huge bull market. You add 4 years to 1982, and you get 1986. Look at the explosive bull market into the 1987 top. Huge money-making opportunity. Add another 4 years to 86, and you get 1990, and again, look what takes place in the market. A big run-up in the market. We add 4 to 1940, you get 1994, and again, another bull market starts in the market. You add 4 to 1994, what do you get? 1998, and look what happens. The explosive last leg of the bull market starts right on that 4-year pattern in 1998. Now here comes the big one, as some of you know, because a lot of you have heard me do this before in lectures around the country for the last 2 years. I've been saying, if you add 4 to 1998, what do you get? And people say 2002. Say, well, let's look at a buy point about October of 2002. So we come to October 2002, and there we are, the low in the marketplace. I have such vivid recollections. I run a hedge fund for stocks. And a guy wanted to invest in the fund, a friend of mine, and his brother is a big-time money manager. And he talked to me in October 2002. His brother said, I don't see any reason he should put any money in your fund. There's no reason stocks will go up here at all. This guy runs hundreds of millions of dollars. He said, well, maybe I'm wrong, but I think something's going to happen this October. No, it can't happen. Well, what have we had since then? A huge up move in the marketplace, right on cadence. So let me ask this question. If you add 4 to 2002, what do you get? 2006. I'll bet we have some type of a bull market coming about October 2006. Now, if you want to really go out in time, if you add 4 to 2006, and on and on and on and on. But I think that this 4-year pattern is the only one of the few time patterns. And those who have the video set, there's a little booklet in there on the Master Stock Market Cycle. You'll see that in the little booklet. That's the strongest cycle that I found in the marketplace in terms of telling us when this cadence is of markets that are going to have strong up moves. There's one other one I'll point out as well, and that was really developed by a friend of mine, Yale Hirsch. Yale Hirsch made a very interesting observation based in part on some work done by Edgar Lawrence Smith. Mr. Smith made an observation that there's a decennial pattern. Commodity or stock prices usually come down into years ending in zeros and twos, run up into years ending in 9, and then bear markets start with years ending in 9, like 1929, 1939, 49, 59, 1969, 79, and 1999, right? Right on Edgar Lawrence Smith's work. Well, Yale made the observation that years ending with 5 never go down. There have been one of them that's gone down. Let me revisit. We'll go back and we'll show you a few of the 5 years. I don't have the data with me, but if you go back to 1905, 1915, 1925, 1935, all wonderful years to buy stock. So, Mark, let's go back to the very beginning of the data that we have. And we go back to 1935. Look what happened in 1935. Big bull market. The middle of the decade. If we come into 1945, that's the next year ending in 5. Well, look what happened in the year ending in 5, 1945. Great time to buy stocks. Now we'll come into 1955. Look what happened in 1955. Well, it might not work in 1965 because things can't work all the time, can they? But we come to 1965, and look what happened in 1965. Big bull market. Yeah, next opportunity is 1975. 1975, huge bull market. 1985, nice bull market. 1995, another big bull market. 2005, we're probably going to have a bull market. Doesn't matter who's president, who isn't president, if they found Saddam Hussein yet or if they haven't found him. I got to be looking for a bull market in 2005. So I think what I've been able to accomplish, hopefully, is we see some market structure, how markets work, that there are some time cycles to markets. There are some price cycles, these small ranges to large ranges. Those are important for you, where you're closing within the range to give us a sense of where to get into the marketplace. In the next tape, we're going to look at actual entries into a market once a market's been qualified. But by now, you should understand how markets move, what conditions are existent at major markets, highs and lows. And when we come back, I'm going to show you exact entry points into the marketplace and the last part of money management, and then I'll wrap it up and you're going to be ready to trade, but not until you've watched that next video.